From New York City for our viewers worldwide, I'm Jonathan Ferro with 30 minutes dedicated to fixed income. This is Bloomberg Real Yield. Coming up, Chair Yellen brushes aside the lowflation story, unveils a plan to unwind the balance sheet and tees up another hike before year-end. Geopolitics fuels the bid in treasuries. North Korea threatens to deliver a hardline response to President Trump. And beyond Toys R Us filing for bankruptcy, heavy debt loads continue to haunt ailing retailers. We start with a big issue: why unwinding a $4.5 trillion balance sheet is apparently nothing to worry about.
I imagine Janet Yellen is doing cartwheels behind the scenes at how well the market has taken the whole balance sheet reduction plan and announcement.
The Fed wants this to be like us watching paint dry. So they say this will be very boring. You know, it's all pre-announced. It's been very transparent. There was no surprise in the announcement yesterday. And so I think we'll be watching a quantitative tightening in slow motion.
I think what she's trying to do is as little as possible. You know, she introduced tightening in monetary policy, and then she was trying to do as little as possible. They're trying to do as little as possible with the dots and keep them as unchanged as they could be in the next 12 months. And then beyond that, then they make the policy changes.
The crisis is over. We still have policy levers largely at their emergency crisis-determined setting. So let's return on a methodical basis the policy levers to normal so we have the ability to control our economies.
Joining me around the table today is Greg Peters, Senior Investment Officer at PGIM Fixed Income, Priya Misra, Head of Global Rate Strategy at TD Securities, and Colin Robertson, Head of Fixed Income at Northern Trust Asset Management. Guys, great to have you with me. Priya, let's just begin with the Fed's balance sheet. The Federal Reserve has been making policy mistake after policy mistake for decades. Yet this cycle, we seem to have this extreme faith in them that everything's going to be okay, that they can unwind a $4.5 trillion balance sheet and everything's going to be okay. Is it going to be okay?
Well, they've widely telegraphed every move. So if you look at every rate hike in this entire cycle, it was 90% priced in, 2 weeks before. So if the market didn't react this week, I think that was because it was the most widely telegraphed unwind of the balance sheet ever. I'm not convinced that the market's entirely priced this in. I mean, they're starting extremely gradually. It's very hard for the market to, I think, price out a year out when there may be 30 billion more in treasuries per month that's going to get issued. The second is we really don't know a very crucial point that the market cannot price in, which is how is the Treasury going to fund the, paying the Fed? Is it going to be all bill issuance, in which case I tell you there's no market impact? Is it all 50-year bonds? There's a very big duration impact. So if the market doesn't have that information, I think we can't price it in. But to start out with, $6 billion per month, absolutely. I think there's enough that the market can handle. It's the path forward. I think the effect might build more cumulatively over time.
Greg, what are your thoughts right now?
I think the Fed is trying to pull a fast one, honestly. I mean, it has to have some effect, right? If you believe that QE, the sole purpose of QE was to tighten up risk premium, force people out the risk curve, affect the portfolio channel, then the reverse of that has to have some effect. It might not be one for one, but it can't be zero. It can't be watching paint dry. I think ultimately, though, the Fed is getting extreme cover from other central banks. And I think that's really the story. It's not the Fed, it's the ECB and the BOJ.
And Colin, we can put that chart up. We can basically show the percentage that the Federal Reserve has of the overall pie, the overall stimulus pie, and it's been declining as the ECB has boosted stimulus, as the Bank of Japan has boosted stimulus as well, and you can see that the Fed's role in global stimulus just slowly rolling over. Is that what we're really seeing here? It's not that the market doesn't care, it's that, as Greg points out, the ECB is giving them some cover.
I think the ECB is giving them a lot of cover, and clearly the balance that the central banks across the globe have on their balance sheets is significant. So even dropping $4.5 trillion down to $2.5 trillion over the type of time frame that the Fed is talking about, I can see why investors would be relatively calm about it. Also, I think Yellen clearly gave herself some room such that if this is not going well, the Fed may just stop and decide, they'll go ahead and stop the case of, bringing the balance sheet down.
Priya?
Yeah, you brought up policy mistake. I wonder how much of that is priced into this no reaction. The fact that the market thinks that this might be a policy mistake, there are a lot of clients that tell me no more hikes. maybe one more, that's it. And if you really believe that the hiking cycle is over, then, well, portfolio runoff may also not continue. So I think to your point, is there a view that this is the unwind that was the smallest ever unwind, and therefore the market doesn't price it in? So I think this policy mistake issue is absolutely in the market's mind.
Priya, something else I'm thinking about, and I think a lot of people were throughout the week, is on a demand-supply basis, it should mean higher yields. But if we look at this through the prism of a central bank that's responsible for inflation expectations, we know through history that actually when they did QE, yields rose, and that you didn't look at it from a demand-supply perspective, you looked at it from an inflation expectations perspective. So why is the reverse not true? Also true? You know, why can't we see a Federal Reserve that unwinds the balance sheet, but actually Treasuries at the long end get a bid?
You know, I can see that if it's clear that it's a policy mistake. So I think the one way you can nuance that argument is to look at real rates. So when the Fed was doing QE, real rates were declining, inflation expectations were rising. So nominal rates actually, which is the sum of the two, actually rose in all the cases. Look what's happened to real rates. Ever since they've started the portfolio unwind, real rates have been rising. Now, I still think they're actually low and they can rise some more.
Yeah.
But inflation expectations, I mean, there's not a lot of inflation. The Fed's telling you it's a mystery, but we're still going to believe that it'll show up. So we're still going to unwind. Inflation expectations are a sale here. I think tips, they're not all that attractive. I mean, break-evens are still pretty high relative to where they could be if this is a policy mistake.
But the curve is flattening,
The
right?
curve is much flatter.
So something is happening. And so if you go back to 2s, 10s from around Christmas of last year to today, it's a pretty big move, right? So it was 136 basis points, and now it's down to 82. That's a pretty decent size move. And the expectation, I think, is if the Fed continues along this path of tightening, the curve will continue to flatten and flatten and flatten. So the yield curve is giving you a signal, I think, that you know, the Fed could be slowing down the economy too much, and to your earlier point, entering a policy mistake.
Priya, 530s at 92 basis points. You know, Greg's jumped on it. What's the message for you that comes from that?
It's a similar idea that, you know, the long end is pinned either because of central banks or the fact that long-term growth or R-star is still low. So all the Fed can do is move the front end up while the long end stays anchored. There's a lot of people who are saying, you know, is this the time for a steepener because the Fed's letting the portfolio run off? I think a lot of that actually is, I'm going to go back to it's going to depend on what the Treasury does. If they do announce 50-year bonds, I don't think there's that much demand for very long end paper.
Yeah.
I think you get a steepening of the curve. If we get tax reform or tax cut, which is actually what it's going to be, which is going to add to the deficit, then sure, we can talk about a steepening. Otherwise, if this is going to be a Fed-led unwind only without any fiscal easing, I think that this curve can continue to flatten.
We had a guest question through the Bloomberg. Given a mix, the FOMC keep 2018 dots at 3 hikes while bringing down the terminal rate. Where do you think the opportunity is? Is it in the long end for term premium or in the short end for more than 2 hikes in 2018? Colin?
It's in the long end for term premium.
Yeah.
I think, as Priya and Greg mentioned, with respect to what the yield curve looks like and the way it's flattening, the Fed could find themselves in a real dilemma. If the curve continues to flatten and their thought process is a number of hikes in 2018, they'll have to take them off the table before we know it, because they just will not be able to tighten into an inversion of the curve.
Greg, it was curious that they trimmed their inflation projection but maintained their estimates for hikes. Now, of course, this whole conversation is redundant, or could be, once we find out who's going to lead the Federal Reserve and who takes up those board positions. But based on what we know now, to maintain your forecast for rates and trim your inflation projections kind of is hard to make sense of.
It is, until you overlay financial conditions.
Right.
And so I don't think they're really focusing on inflation. I think they're worrying about that very little, in fact. Growth is strong, you know, kind of global cyclical upswing. We know that story. But financial conditions are as loose as we've seen them. And I think they're focused on that much more so than the inflation picture.
Priya, is that what's going to lead them, though, ultimately to make a policy mistake, that they're focusing on the wrong thing?
So I think that's part of it. They could continue to try and tighten financial conditions.
Yeah.
They might go more. I wonder if it's this belief in what Nehru is, or R-star, all these unobservable criteria that's making them continue to hike. What if R-star is 0? and stays zero while the Fed believes it's going to rise. I wonder if that results in higher rates. And I guess back to Greg's point, I wonder if the fact that this hawkish reaction function, was that also a function of them having a different reaction function because they're trying to normalize? What we're hearing from every central bank, we're trying to normalize, we're not actually trying to tighten. At some point when they want to tighten, I wonder if then they will actually care about inflation a little bit more.
I think we're all trying to understand what the Fed's reaction function is and have been for quite a while. Everyone's sticking with us then. Greg Peters from PGIM Fixed Income, Priya Misra from TD Securities and Colin Robertson from Northern Trust Asset Management. Coming up on the programme, the auction block. President Donald Trump made waves at the UN this week with his strong talk about action against North Korea. That region's bond market, though, has been shrugging it off. That's next. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. I want to head to the auction block now. Last week we had Tajikistan offering some eye-opening demand with that auction from that country. This week we had Ukraine. The country received bids for 3 times the $3 billion it offered in its first foray into the market since Russia invaded Crimea in 2014. The demand for the 15-year bonds was so high that it knocked almost 40 basis points off the initial price guidance. And despite tension in the region, this quarter has seen offshore bond sales by South Korean issuers climb to the highest level since 2013. Debt offerings have risen 22% to $8 billion. Deals include a $1 billion sale by Korea Development Bank this month. And to wrap things up, the clamour for yield did not extend to South Africa. The nation had to pay more to sell 10-year euro bonds than it did on 12-year debt last year and managed to attract only $2.1 billion in bids for the $1 billion offered. But the story of the week was in credit. Toys R Us. Quick descent into bankruptcy shocked debt traders this week. The market is picking through an over-leveraged industry and asking which other retailers will struggle to harness their debt. Investors are left asking, why did nobody see this coming? Still with us is Greg Peters from PGIM Fixed Income, Priya Misra from TD Securities and Colin Robertson from Northern Trust Asset Management. Greg, that chart is stunning. We trade at close to par over the last 12 months. Then within 2 weeks, roll over to 29 cents on the dollar. Why?
Well, I think people were surprised by just the timing, right? So you think about the toy selling business, the peak season is heading into the Christmas time, right? And so I think investors were thinking that they had a little more runway, and they found out that they didn't. But I think the Toys R Us story is an interesting one because it's a holdover of what happened last cycle. So it was part of the LBO boom, 2005 deal that was extremely levered. So it's less of a retail story and more about a too much debt story. And I think you need to kind of bifurcate and separate out those issues and not paint retail just under the same brush. And
Colin, we can show that. The debt servicing costs of this company were phenomenal. They were $350 million a year. They were pushing $500 million a year at some years in the past as well. And we can bring that up for our viewers. Is this a standalone story, though? I do wonder. And if we knew about this, once again, I go back to the chart of the credit. Why didn't people see it coming? It wasn't in the price at all.
Right. Well, I think people saw it coming in the sense that it was a when, not an if. So this was going to happen, but there was just a miscalculation on the timing. As Greg said, thought process, get through the Christmas season. Maybe it's a 2018 issue, but clearly it was knowable, as you stated. And I think there are some other knowables out there. You can see the companies that are over-levered and have too much debt. But it's not a total one-off. Yeah. But as Greg mentioned, you don't throw away the whole sector just because of this issue.
You shouldn't, Greg.
That was a one-year piece of paper that you showed, right? It was dancing between the raindrops a little.
But if you look at the CDS, and you and I have talked about this, the bottom line here is that markets and investors completely failed to price default risk.
They did.
You know, it wasn't like we were trading in the 80s. We were trading in the high 90s. We weren't pricing in anything. And I just wonder why and where else that's happening.
Well, it's hard to say. I mean, we've also seen this in the banking space as well. Earlier, a few months ago, with Banco Popular, right? And so, you know, the market seems to be more surprised by these, you know, events. But I don't think it's broad-based. So I'll go back. I don't think the market is categorically mispriced. I think this is an idiosyncratic issue that definitely took the market by surprise. We have seen an increase broadly of idiosyncratic issues. But that doesn't taint, I think, the overall market. And if you look at just high yield, sure, the default rate in the retail sector has jumped. Now the loan space is up to 7.5%, but the rest of the high yield market is sub 2%. So I think these are localized issues. It's not endemic.
Well, Colin, let's talk about the price. We can overlay the Bloomberg High Yield Index with high yield energy and high yield retail, and there's quite a spread. 100 basis points energy over the benchmark, 200 basis points there and thereabouts for retail. But it did interest me that those two things are rolling over. They're getting tighter over the last month. Greg says the price is justified. Is what you're seeing on the screen right now justified?
I actually agree with Greg. I think the market is fairly priced here. As Greg pointed out, you have some circumstances where, you know, maybe we've gone tighter than some believe in some of the sectors, but the bottom line is there's still a hunt for yield. There's still a reason to be confident in high yield, and I think the prices are fair here, and I actually think that spreads will tighten from here. The
price is fair. Is conviction high?
Conviction's not that high. I think that's probably the tougher spot and a better question. I think that there's conviction because there's nowhere else to go in some cases, and so the central banks are a big part of this. They leave investors in the market with only limited choices, and this is an area where the choice is a good one still.
Priya, from a macro picture, I wonder how many companies the Fed is keeping in business that shouldn't be in business.
Right. And as a Treasury bond investor, I'll take the negative side of this.
Of course, please do.
There's a lot of reach for yield.
Yeah.
And I think that's why, you know, risk reward becomes a little bit stretched. And the BIS actually has been talking about this for a while. They just recently talked about the total amount of dollar debt that's outside of the US. Now they've added FX forwards, derivatives on that. There's a lot of leverage here on rates rising. And not only do you have the Fed and the unwind, if the ECB starts tapering, do we get a rise in rates, which, you know, maybe it's idiosyncratic and not the entire credit market, but if lots of these idiosyncratic events start coming up, I think from a systemic basis, the market will get worried.
What are your thoughts on that, Greg?
No, I think it's an excellent point. I just don't know if it's now. I think ultimately what we're worried about is the ECB taking stimulus away. But it doesn't seem to be a here and now story. But I think high yield, so like high yield is very different than investment grade. So the difference of the high yield market versus the investment grade market is that investment grade companies have really feasted on this low yield environment. They've been issuing en masse. Each year is a new record in terms of gross issuance, and they're levering up. High yield's a different story, which makes Toys R Us interesting because post-crisis, you have this Fed leverage cap at 6 times that's actually containing the high yield market and making it a much more rational market today than what we've seen in the past.
Guys, you're sticking with me. Greg Peters from PGIM Fixed Income, Priya Misra from TD Securities, and Colin Robertson from Northern Trust Asset Management. Before we go, let's get you an update on the markets this week, shall we? The Treasury market, 2s, 10s and 30s, yields higher on 2-year notes by 6 basis points, on a 10-year by the same amount, and on the 30-year by 3 basis points. It is still a flatter yield curve. Still ahead, the final spread, the week ahead featuring Draghi, Yellen and Carney, all coming up next week. This is Bloomberg Real Yield. I'm Jonathan Ferro. This is Bloomberg Real Yield. Time now for the final spread. Coming up, an incredibly busy week. German elections coming up this weekend. The Prime Minister of Japan, Shinzo Abe, might call a snap election. And then we have these big three: Mario Draghi, Janet Yellen and Mark Carney, all speaking, plus you might have a possible healthcare vote in Washington, D.C. to throw in there as well. Still with me is Greg Peters from PGIM Fixed Income, Priya Misra from TD Securities and Colin Robertson from Northern Trust Asset Management. The Fed speak, the central bank speak next week, Priya. Is that a good thing or a bad thing?
Well, given that, the central banks are driving a lot of price action, I think it's a good thing. When you have too much, is there confusion? I'm pretty sure there will be. We've got leadership change at the Fed. So apart from Yellen, there's 11 other Fed officials that are speaking next week. So it's going to keep us on our toes, and I think that's going to keep us probably within a range. But I think we want to definitely understand long-end rates. We want to understand inflation, what gives them this confidence on inflation. But I'd be watching Draghi a little bit more. I mean, it's technically autumn now, or the fall, so he has to
that was
signal.
the guidance.
That was the guidance.
But Greg, it doesn't look like they've got a clue what they're going to do yet.
No, it doesn't seem that way. But the last meeting and press conference, the market interpreted that there's something to do in October. And so I think all eyes are on him to clarify that statement. Even though he didn't say anything, the markets are looking for him to clarify.
What's your base case for October now?
I think it's steady as she goes. I mean, the challenge, right, if you look at kind of their inflation numbers, which are lower today when they first embarked on this journey, I think their real challenge is just structural. They're running out of bonds to buy, so they have to do something. So I do think, they may announce something, but I think they could also extend it at the same time. So I don't think they're willing to give up yet.
Has Janet Yellen made Mario Draghi's life a little bit more difficult executing this balance sheet policy story now?
Definitely. There's no doubt about that. And I think she makes my life difficult because within the Fed, we don't have any definition of whether they really think inflation is structural or transitory.
Yeah.
And until they come to a consensus on that, I think they're making not only Draghi's life difficult, but all of ours too.
But Colin, the bias is to hike. It seems to me that the bias is still to hike. The bias is still to maintain interest rates and expectations for them as they are. Are we in for a surprise the next time we get the summary of economic projections?
I think that's possible. I wouldn't be surprised, but I'd say I'm not sure. But given what the Fed has projected that they're going to do next year, I think a lot of things need to hit on the perfect cylinders for that to happen.
Priya, is it possible that you get to the end of the year and actually the story has changed for the Fed on inflation expectations?
I think it's a little quick for them to capitulate on the entire Phillips curve. If the labor market turns and we start seeing much worse data, absolutely. I think a lot of their faith is based on the fact that the labor market continues to tighten. So, but if the labor market's still chugging along, I think it's soon. A year from now, if the labor market's still okay and we're not seeing inflation and the wireless component has fallen off, I think she's taking a lot of faith in the fact that wireless, half the drop in core CPI was wireless driven. When that's out of the data and inflation's still not picking up, then I wonder if the Fed thinks that they're in a bit of a catch-22, right? They think inflation will pick up, so they're trying to hike, but by hiking almost too soon, they actually prevent inflation from rising.
Guys, we're going to have to leave it there. A special thanks to Greg Peters, of course, from PGIM Fixed Income, Priya Misra from TD Securities, and Colin Robertson from Northern Trust Asset Management. That does it for us from New York. We will see you next Friday at 12 New York time, 5 p.m. in London. Of course, we will bring you a week full of Fed speak and Yellen, of course, with Draghi and Carney as well. This is Bloomberg Real Yield.